now that we are done with the issue of shares, I'd like us to look at the buybacks. So, in order to gain control of the company and also to increase shareholder value, companies would buy back shares. So, they'd go back to the public and say, we are willing to buy back certain number of shares at this value, and then a certain number of shareholders would buy back those shares. So, what we need to realize with that transaction is that the company is now giving up part of the capital that they had initially received. So they are giving up some of the value out back. So that will decrease our ordinary share capital as we've highlighted initially there, right? So what I then want us to go back to look at is how this money is obtained, or how this value that is going to decrease our share ordinary capital obtained. So what they say is we take the total value of our ordinary share capital and then we divide it by the number of shares that have been issued. And so this is normally nicely done through visualizing this note here, or this reconciliation. So the average price, now, it is the price at which the shares are worth at that point in time, right? So I want us to look at this by a manner of a transaction. So let's say here it's the buyback of shares. So buyback of shares. So I want us to do just a mini example. Okay, so let us start. So let's say that continuing with our initial thingy example, let's say now the company bought back 30,000 shares at 3 rands per share, right? So now we need to look at this and analyze it in terms of these two things that are actually happening here. So we look at what has happened and for what purpose, right? So I want us to look at our journals. So the first thing that we need to do is to have our debit there now. So we've bought back shares at 3 rands. So our ordinary share capital is going to decrease, and it decreases on the debit side. So here we will have our ordinary, let's take the red pen there. So we would have our ordinary share capital there, increase it a bit. So cash should be fine now. So our ordinary share capital then, ordinary share cap. And then we would write a certain amount there. We will come back to that. And then the second thing that we need to look at is that, so what had happened, for what purpose? So we had paid money for buying back the shares. So if we paid money, it means that our bank is going to decrease. Bank is an asset, it decreases on the credit side. So we need to have bank there. And then that's how much we've paid. We've paid 3 rands per share. So 3 times 30, that should give us 90,000 rands there. So sorry, let's write our bank in red to show a decrease. So we would have our bank there at 90,000 rands, right? So now the concept of the average share price comes into play. So the ordinary share capital that we have there, we need to record it at the average share price. So how do we get the average share price? So we'd say that the formula is the total of the ordinary share capital divided by the issued shares at that point. So continuing with our example, the issued shares at this point were 50,000, right? And then the total ordinary share capital was 100,000. So we would need to say 100,000 divide by that 50,000 issued shares, and then we would get the average share issue price of 2 rands. And then we would multiply this 2 rands by those shares that we've bought back, which is 30,000, and then our answer of 60,000 would come in here, right, as our debit. So the principle here is, so we would have our 60,000 here as our debit. So the principle and the reason of not writing 60,000 here is, initially we had raised this much capital through issuing shares, and now we are giving up this much capital. So the capital that we are not giving up is not valued at the price that we had paid. We need to check it. What is the value of the shares today at this date in which we are buying back the shares? So the value of shares at this date is that our ordinary share capital was worth 100,000 and we had 50,000 shares issued. So we divide and then we get that 2 rands there. And then that 30,000 multiplied by 2 rands will be the 60,000. So, but if we see here, we have 60,000 here, we have 90,000 here. Our journal is not balancing. So what they normally say is, so the difference between this, it means that we have paid more for less. And then that difference between this is normally funded through retained earnings. So we would then come and balance our account here by having a debit that is going to go to our retained earnings there. And again, the reason why we are debiting retained earnings is to say that the shortfall of funding this 60,000 by the 90,000, we got 30,000 from our retained earnings. And again, retained earnings is an equity account. It decreases on the debit side. Hence, we are debiting it here because of we are saying that the excess of 30,000 over the 60,000 was funded from retained earnings, which is our profits that have been retained. So I also want us to look at this in a form of a T account and see how it would apply. So in our T account, so let's have our T account there. Different pen. So we would have our T account there. So I want to have 3 T accounts. That's going to be 1. And then let's include a third one. Okay, maybe here. Cool. So this is going to be our ordinary share cap. So it's ordinary share cap here. This is going to be our bank. And then this is going to be our retained earnings because of we have 3 accounts there. So we had said that when we opened the year, we did not have any shares, right? So we had 0. Our opening balance was 0 there. But then we had issued shares. So when we issue shares, it means that our bank is increasing by 100,000. And in terms of the double entry principle, we have to think that if we had received 100,000, it means that our bank is also going to increase there by the ordinary share capital of 100,000, right? And then we move on to say that we had then paid 90,000 rands for buying back the shares. So this 90,000 rands in your bank account is then split into 2. We are going to have ordinary share there, and then your ordinary was 60,000. So 60,000 was there, and then we would have your retained earnings there. Your retained, which was 30,000 there, right? Apologies for this tiny mess there. So that's how this 90,000 is split in terms of the T account. 60 plus 30 is that 90,000 that was paid for there. And then we come here and then write our bank to complete our contra account or our double entry principle. So the bank there, and then we'd have to remember that our ordinary share capital was decreased by the 60,000 there. So we'd have the 60,000 there to decrease it. And this 60,000 is that 60,000 that was transferred there. And then we go to our retained earnings to come right there, our bank, which was that 30,000 that matches there. I hope this makes sense. And then one last thing that I would like to highlight in terms of these shares, right, that we bought back is sometimes they like to complicate how we arrive at the answer. So we would have to think in terms of how can we manipulate this balance of this reconciliation of our balances there. At times they can give you the closing balance but not give you this figure and then give you everything else. So you can just work back and solve for that. So if we now at the beginning of the year we had our ordinary share capital. So let's do this here. So here we have our let's say at the beginning of the year we had 10,000 shares that we issued. Okay, shares in issue. Shares issued at the beginning, nah? So we had 10,000 shares issued. Let's say we had issued those 10,000 shares at let's say at 1 rands, or let's say 3 rands. So we would have 30,000 as our opening balance there. Né? And then we continue to say that now during the year we had that 50,000 shares that we had issued. Né? Sorry, let me use a heavier pen there font. Cool. So just remove this. So we're saying that we now, during the year, we issued that 50,000 shares issued, and then we had said that these shares, we had issued them at 2 rands, and then they'd given us the ordinary share capital of 100,000. And then now we come at the end of the year to say that we had bought back 30,000 shares. So we need to reduce this here. We would have our 30,000 shares there. Okay, let's just go up. So we would have our 30,000 shares there, and then these are shares bought back. So now the concept of the average issue price is again saying we take the total ordinary share capital at the point at which we are buying back the shares, and then we divide it by the number of shares at that date, right? So what we do now is to come here and say our total ordinary share capital at this date is 130,000. Do we agree? And then that the total number of shares that we had issued there, we had issued 60,000 shares. Let me get my calculator. So now we are going to say our average issue price is the 130 divided by the 60,000 there, which is going to give us a 2 rands 16 cents. So the value that is going to go there now, we are going to say that's 2 rands 16 cents multiplied by that 30,000 that we had bought back. And then here we would have 65,000 that is decreasing our account. And then we then need to have our closing balance there. Sorry, different pen. So our closing balance now would be that 30,000, right? Plus the 100,000, and then minus the 65,000, which would be another 65,000, right? So we're saying 30 plus 100 minus 65. It leaves us with 65,000 again. Okay, that was correct. And then we'd also need to balance this side, the number of shares. It's our 10,000 plus 50,000 minus 30,000, which leaves us with 30,000 again. So at the end of the year, we'd have 30,000 shares at the end, right? And then this balance again must be the same with the balance that goes there. So for purposes of completing the journal with this new information, we'd have to remember what we need to do is to have our ordinary thingy. We are going to debit our ordinary share cap first, ordinary share, and then the value was at how much did we decrease our ordinary share cap there by? We had decreased it by 65,000, right? And then we would need to debit our retained earnings, and then we'll credit our bank. So our bank is the money at which we've received. So we'd say that we had received in 90,000, right? And then the difference between these two, which is going to be 25,000, now goes to our retained earnings. So I hope this makes sense. Again, we need to draw a distinction between the money that the company actually paid and the value of capital that they've given up. And that value of capital that they've given up, we determine it by taking the total ordinary share capital at the date that we are selling the shares and divide it by the total number of shares that were issued at that date. See you in the next video. Thank you.